Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Beko and my partner, Hari.
Hello.
We will continue our discussion with McDonald's in this episode. And if you haven't checked out our first podcast, please do so before listening to this one. All right, Hari, let's get started.
Yeah, so before we get started, we have a disclaimer. This is the Value Investor TV podcast. We are a podcast that helps you understand the concepts behind value investing. We are not financial advisors and we don't know your specific financial situation, so please consult with the appropriate advisor before making any investment decisions. Okay, so we were talking about McDonald's, and in the previous episode, we kind of went over what is the business, what we thought our competitive advantage was for McDonald's, and we heard that McDonald's was really not growing their top line revenue. It was kind of negative 0.7% for the last 10 years, and in the last 3 to 5 years, they've actually been accelerating their negative growth by to a negative 5%. So, we saw a business that spends a couple $1 billion a year in capital expenditures to open new stores. But most of their CapEx was actually focused on, refurbishing their existing stores. So, looking at those things, one of the things that we want to see, our next episode, we're actually going to talk about this return on capital and why it matters for even a business that's not growing. And for those of you who don't really know what return on capital is, I'd highly recommend listening to our earlier episodes where we do break down the financials of companies and what all the financials means. But and we're going down our checklist now. And the question that's coming up here is McDonald's able to translate its moat, which we said was based on its significant brand, into a high return on capital?
Yeah, so let's take a look at that. So before we do that, actually, this is a new kind of metrics that I've seen this metric before, but I think it's interesting that they use this. They use return on incremental invested capital. Okay, so it's not return on invested capital, it's incremental invested capital. So what that actually means is this is something that they actually report on in their 10K. So I think it's important to just note that, highlight that here. So how do you calculate this? So the way you calculate this is on the denominator, on the bottom. Actually, let's start with the numerator. Numerator is basically it's basically the same thing. It's operating income, and you add back depreciation and amortization. That's the numerator. But what you do, so that's what you do. And on the bottom is weighted average cash used for investing activities. And so you take that, but the difference here is that instead of taking the sum, so, for example, you'd be taking, for example, in regular return on invested capital calculation, you'd be taking just, straight of liabilities or asset from that year, right? That snapshot. But what this is doing is they're taking the difference. So say return on incremental capital. So what they're doing is they're taking the difference between 2019 number and 2018 number and then dividing that by the invested capital.
Boy, I mean, it sounds like McDonald's uses all parts of the cow, including the poop, when they generate their when they discuss return on capital, huh?
So I think it raises some red flags here, because what it ignores is it's just looking at the snapshot, right? It's just looking at the difference. It's not taking into account the entire full story, right?
Yeah, I mean, first of all, if you're adding back depreciation and amortization, what you're looking at right there is EBITDA, right? And so if you're using EBITDA as a thing, right, then you're trying to compare that to how much money do you have to spend, to maintain your business as an incremental, investment. So there's several problems with this. One, it's hard to calculate this against another business, right? Because not every business is going to report this, and not every business is going to use it, right? So I would like to know how much a franchised business similar to McDonald's in size would get as a return on capital, right? And if they're using a different metric, it makes it hard to measure that, right? I mean, you can say these things, right? But at the end of the day, what I would want to see is EBIT over invested capital. So assets, minus cash, and so on. So
exactly.
what do you think of their normal of normal metrics here?
Yeah. So obviously there is some baggage associated with return on incremental invested capital. But if we just look at EBIT over capital employed, so this is return on capital employed, they get about 20%. So 20% is what we get. And the way I calculate that is EBIT as a numerator and a denominator. It's capital employed, and the way you calculate that is you take the asset and then subtract the current liabilities.
Okay. Yeah, and that's really the number we would want to look at in a company like this, right? They are a somewhat asset-light business because they don't actually own the restaurants. They have franchisees who do that for them. So for the most part, these companies are asset-light, right? This was the original asset-light business model, before tech was kind of around. So, I think that's the number that I would use for anything that we're looking at here.
Yeah, and if you look at return on invested capital, ROIC, it's around the same. And also, we also have to make sure that you use not just one single year's number. You kind of have to look at it more globally. And for the past 10 years, let's say, you're getting around that number. Around 20 to 25, roughly, is the number that you're seeing here.
Okay. Which kind of makes sense. I think the thing is that number is going to decline as the revenue declines too, right? Because their asset and their expenses aren't really going to change unless they can significantly cut down expenses. And, I imagine labor is a big part of that. And, in states where they're going to have squeezed minimum wage laws, you're going to end up with businesses moving to some sort of robots or something like that to meet the food demand. So that may be something that they'll have to invest into to lower costs. But okay, we've talked a lot about return on capital. We should look at the rest of the balance sheet and the income statement here. So does the company have enough cash to operate and maintain its business?
Yeah, so I like to look at the short term and then also the long term here. So if you look at the short term, I like to look at the current ratio. So the current ratio right now, and the way you calculate the current ratio is you take the current asset and then you divide that by the current liabilities. Right now, it's right at around 1. And historically, it's been above 1. It's been around like 1.5. In some years, it peaked at like 3 or something like that. Yeah, 3.2. But overall, for the last 10 years, it's been around 1.5, let's say.
Okay. So let's talk about debt and free cash flow, because I think this is an important part of seeing if McDonald's is going to run into financial problems in the future. So does the company maintain reasonable debt levels? And we typically call reasonable something that they can pay off with free cash flow in 3 to 4 years.
Mm-hmm. So this is where it gets really interesting. So the debt has been growing at a compounding annual growth rate of about 10% for the last 3 years.
Oh, we found some growth. We found some growth in McDonald's finally.
Here it is. Here's the growth.
Yeah. I asked you the question, Becco, what are their prospects for growth? And you held out on me till here.
Exactly.
This is unacceptable, Becco.
We found the freaking gold mine right here.
Yeah, keep borrowing money.
This is where the growth happens.
Yeah.
This is the reason why you didn't specify in that question
I didn't. You're
What is the
right.
prospect for growth, right?
No, this is clearly on me. I'm an idiot for writing this checklist and not including the word revenue or
Yeah.
income. But
Yeah, so this is where it gets interesting. So the past 3 years, it grew at 10% a year. For the last 5 years, it grew at 18%, and then for the past 10 years, it grew at 12%. So it's been basically growing at 10% every single year for the past 10 years in debt. And now what we end up with is with a balance sheet that is that is that is burdened with $34 billion of debt.
and
Yeah, $34 billion of debt.
and for context, they have 20 billion in revenue, roughly.
Yeah, so for context, they have 20 billion in revenue, and for free cash flow, they get about 5.
Okay.
And just one more thing, I think it's important that we start looking at this now, because of COVID and all these other things that require kind of short-term capital crunch. If you look at when are these debt due, in 2020 we're okay. Debt obligation due in 2020 is about $60 million, so not that bad. But if you start looking ahead a little bit, 21, 22, and 2023, it starts going up. 2021, the debt obligation you have to pay back 2 billion. The year after that, 2022, another 2 billion, and then the year after that, 6 billion, and so on and so forth.
So they're going to extinguish 10 billion in debt in the next 3 years, which
Yeah.
which is not, free cash flow does cover that. But that still there leaves another 24 billion that is 3 years and beyond.
Yeah, free cash flow does cover that, but then we have to think about. We'll get to this later when we talk about management, but shareholder interest alignment comes into question when you look at dividend and share purchase stock buyback programs.
All right. Well, if you weren't paying attention, McDonald's is a growth company. All right, moving on.
Moving on.
The to management. So you just it was a good segue, and I blew it. But is management properly incentivized to protect shareholders' interests over its own? And a couple ways that we normally think about that is, is there a founder running the company? No. In this case, McDonald's is, too old for that. Or does someone or some group own a significant portion of their net worth in McDonald's?
Yeah. So right off the bat, let me just paint a little bit of color on what went down last year. I mean, this is like a frequent occasion nowadays. The CEO got fired for having a relationship with one of the employees, which violated the rules and regulations within the company. So a new CEO was instituted pretty recently, actually. If you look at the board makeup, it's interesting. Actually, let's talk about this later after we talk about the shareholder return in terms of the dividend payments and the shareholder buyback program.
Okay. So new CEO. Have they managed has management handled excess capital in a shareholder-friendly way? So we typically think of this as, for a business that's not growing, they don't have a lot of places to deploy capital to grow their. You would want them to buy back shares and pay a hefty dividend. Are those things occurring? Do we see that as a sustainable thing for the future, and so on?
Yeah, so if I look at their dividend payments as well as stock repurchase program, and you sum them up and just say, let's just call that total shareholder return, right? And then you divide that number by free cash flow. What you get is a ratio, and the ratio tells you that if that number is below 1, that means that these programs for shareholders, either through dividend or stock purchase, it's really within the limits of free cash flow. So you're not overextending your company to draw out debt or tap into cash reserves and things like that to pay out in excess to shareholders. Now, if price makes sense, for example, for stock purchase programs, if the company is trading at such a discount, then it might make sense to do all these things. But for the largely the history of McDonald's, it hasn't been trading really cheap. And so if you look at that number for McDonald's, it has been consistently above one, meaning that they're using above and beyond what they get from free cash flow to dispense checks to shareholders in the form of dividend, and also buy a whole bunch of stocks through the repurchase program. So just to give you some more color on this, last year, 2019, free cash flow after CapEx, we talked about CapEx earlier in the episode, after CapEx, free cash flow is about 5 billion, right? 5.8 billion. If you sum up the total return to shareholder, it's about 8 billion. So where is that 3 billion coming from, right? And if you look at the cash reserve, it's been going down. If you look at the debt, it's been going up. And if you actually if you look further back into history, it tells a very interesting story. So cash peaked in 2015, and also the total liability starts really ramping up in 2015, 2014. And the trend has been consistent ever since. So they're drawing debt to execute these buyback programs and stock dividend payments. All the while, the debt is, the balance sheet is basically getting levered.
So can you kind of give us an idea of how many shares have they retired, or what percentage of their shares have they retired in the last 3, 5, and 10 years?
Sure. Number of shares outstanding right now is about, let's see, it's about 750 million shares. And they started off, let's go back to 2010, for example. They were at a billion shares.
So they've reduced the share count by a quarter, 25%, which is not, it's not fantastic, but it's pretty good. So they were probably buying back shares when the market was still valuing them at a premium, it sounds like.
Exactly. And so I dig a little further into their board composition, because these sort of behavior is very noticeable in the private equity sector, right? You load up and you execute on these big buyback programs, and everyone is happy. Banker is happy, the executive is happy, and you walk away with fat bonuses, right? So that's basically the business model of private equity firms. If you actually look at the board makeup, I was actually surprised by this. People who sit on board sometimes are not really related to the business itself, right? And that's fine. Sometimes people do that. Like, for example, in McDonald's board right now, there is a commissioner of Women NBA, Women's National Basketball Association. There is CEO of Common Spirit Health. This is a big healthcare system in the U.S. CEO of Abbott Laboratories sit on their board as well. But they also have this guy named Robert Ecker, who's been on the board since 2003, and he runs a private equity firm. And if you date back these sort of practices, it really started earlier in 2000s. And you can see that. You can see that ratio going up. Again, that ratio I talked to you guys about. You want that ratio to be below 1 because, normally in normal times, right? You want that ratio to be below 1. That ratio started to go above 1 since 2006, and it has stayed up above 1 ever since then. So I think it paints a pretty logical and interesting picture of Walmart, or not Walmart, sorry, of McDonald's here.
Yeah, well, given what we've seen here in a declining business, one that is basically borrowing money to pay out dividends and buybacks, why don't we look at the value of the business as we see it today? and see if we're anywhere close to something that's cheap, right? I mean, there's still a potential that McDonald's, as a big, huge corporation, can, manage their debt appropriately. They can start paying down, these loans, and then kind of, But it sounds like what is going to have to give in this situation is you're not going to see as much in the way of buybacks or dividends, right, going forward, which I think will cause a huge drop in the value of McDonald's, as it stands today. But let's see what that value is, and then see what potentially. I mean, we identified a very strong moat business, but that just because they have a strong moat doesn't mean we want to buy, right?
Mm-hmm.
So what do you think the margin of the value of margin of the businesses of McDonald's, and what is the margin of safety price at which it would be worth looking into?
Before we jump to that really quick, I do want to paint just a little bit more color on the business itself. And I talked about it in the first episode, but they basically run two separate business lines, right? One business line is company owned and operated restaurants. The other one is a franchising business. And if you look at the revenue breakdown, right? Let's just take last year, for example. It's, I thought, for me personally, I thought the top line revenue was much more skewed to the franchise restaurants. I thought it was like 99% of it. But if you actually look at the breakdown, it's about 50-50. So last year, they brought in about $9 billion from sales by company operated. And then from franchise, they brought in about 11. But what gets interesting here is if you look at the margins, right? The gross margins, it obviously is much in favor of the franchise restaurants. The gross margin on that is about 81%, while company operated restaurants is about 17%. So I just wanted to give listeners color on that. And then one more thing I do want to shine light on is this, which is if you look at the percentage breakdown in terms of revenue, the company-operated revenue has always been above the franchised restaurants. Now, as I mentioned before, the net income is a different story, and the gross margin is a different story. But just looking at the top line, company-operated revenue, sales from company-operated restaurants made up about 60%, and then it is slowly flipping. So right now, starting in 2018, the majority, so over 50% of revenue, is coming from revenue from franchise restaurants. So the company is really pushing franchise restaurant business much more aggressively than the company operated one, because of the fatter margins on those business lines. Just some color on that.
Okay, let's talk about valuation, because I think that's none of it matters unless this is worth investing in, right? And we've seen a lot of red flags already. So what do you think the valuation and the margin of safety price would be?
Yeah, so we start with initial cash flow. Again, you want to kind of average that out. So if you start with that, and I said the growth rate is, let's say, none for the next. I'm being really conservative here, right? Being, let's say none for the next 1 to 3 years, and then it grows at 5%, and then 5%, from 4 to 6, and then 7 to 10. And the reason why I say that is because, from the buyback standpoint, from earnings per share perspective, it has been growing at a pretty healthy clip. So for the last 10 years, it grew at 6% earnings per share every single year, compounded an annual growth rate of 6 to 7%. So that's why I said about 5%. So with that assumption, if you just run the numbers, you get the intrinsic value of $45 per share. Right now, it is trading at right now, and today we're recording on the 28th of June. And right now, the share price is about $180.
Whew. Okay. And that's with a pretty aggressive, revenue of 0 and 5, or a free cash flow growth of 0 and 5% per share. So, and we may see the free cash flow has to be used to pay down debt here soon. So some of that free cash flow may not actually contribute to share buyback or earnings per share growth in this case. So,
Yep.
okay, so we are at a business that is grossly overvalued. We would want the company to either preserve cash at this point to pay down this debt, or and not do buybacks because the price of the company is too expensive, relative to the value of the business. So, yeah, it doesn't sound like there's a compelling business here in terms of price.
Yeah. I think I'm just, yeah, there's nothing here for us. It's clearly, I mean, there's so many red flags already everywhere along this checklist. So clearly, this is something that I want to stay away from as much as possible. And this, it reminds me of, what might happen to the famous Toys R Us stories, or stories of these, great companies that's been built over the years, and with mismanagement and things like that, it just crumbles under its insurmountable debt. And I just hope that doesn't happen here.
I do think it's kind of hilarious that CEO of a healthcare system is on the board of McDonald's. I mean,
Yeah.
is he drumming up business? Is that what he's doing here? Load them up with salt, and then they get a heart attack, and then they come to the hospital. So I think this is not atypical though of very large corporations, right? They don't have a driving principle anymore, and so a lot of their success is based on coasting, kind of, right? They've coasted on a brand, which I think McDonald's can have a lot of missteps and not lose revenue, not lose significant amounts of revenue. One thing we didn't really talk about here was the impact from coronavirus, and I think they saw a drop of about 5% same store sales here in the last quarter, and so it may be more significant in quarter two. But do you think that there's any impact from coronavirus that may accelerate the timeline that we were talking about of having to pay back debt or anything like that?
I don't think so. I think they'll coast as is now. Um, they have a pretty, they're well-known companies. I don't think banks will be shy from lending them more money, refinancing and all that. I don't think that's going to be a problem for this company, McDonald's. I just have, a lot of worries about long-term prospects of this company. Just because of the debt load and, all of that. So.
Yeah, I mean, I just to wrap up here, I think one of the things that, as you look at this, we are seeing a pattern amongst a lot of businesses that after the 2008 recession, a lot of them loaded up on debt because the interest rates were so low that it seemed like it was basically free money, right? And now you have a levered balance sheet with an enormous amounts of debt, and what it's going to end up doing is the next 5-10 years of the company's life is going to be essentially just paying down their debt, right? They took all this money. They really haven't seen any value returned to their shareholder in any meaningful way. I mean, 6% growth rate that's not enough for me to, be excited about it. But you basically levered up $30 billion and, to do that. So I think the financial discipline here is going to hurt them long term.
Yeah, if you look at their share price performance, EPS, if you look at their incentive structure, executives did what they are, what they should be doing, which is follow the incentive structure. If you look at the incentive structure, it's very clear that share price, EPS, is clearly motivating factor for them, and juicing, getting the last squeeze out of this as much as possible, loading them up in debt. There's no consideration for long-term, health of, financial health of this company. And to your point, Hari, a lot of these companies, a lot of big companies are in this space of coasting. And it begs the question of what is a graceful way of coasting? Not be too greedy and juicing up, the returns by levering up.
Well, I mean, I think the other thing that you have to really consider when you look at a business like this, right? This is not something that we would be interested in unless it had some sort of cigar bet kind of setup, right? And, for those of you who don't know, a cigar butt is kind of like it's on the floor. You take one last puff out of it and then you throw it away because there's nothing to it. If this were purely cheap, there would be something interesting, but there's no growth here. There's no long-term prospects. And they generate a decent return on capital, but it's all going to be paying off debt here in the near term. So, I mean, to me, the answer for a lot of these businesses is you're going to see in the next 5 to 10 years a large cap company flatten. They're going to just flatten in terms of all of their growth, right? Because they're going to have to pay down, debt. A company that generates $6 billion or so and $7 billion in free cash flow, I mean, they're going to have 5-6 years to pay this, of just pure free cash flow to pay down debt. It's not a great, setup for anybody, right?
Yeah.
And so, they can pay it off. I don't think it's going to kill them because they'll renegotiate their terms. As long as their free cash flow stays above a certain number, I think they'll be okay. But why even bother? I mean, who is owning a business like this expecting any type of return at this point? And justifying a price that is so high relative to their free cash flow, right? It just doesn't make any sense. This is not a business that's growing, so why would you assume that the future you're going to get higher, cash flow? They don't deserve that multiple. So,
Yeah. Yeah, I do think if you look at the share price performance, for example, as I mentioned before, like they're going up, but at what cost? And at some point, you just have to face the reality that the debt is just going to grow and grow and grow, and before you know it, not even free cash flow. If you just look at just interest payment alone. Right? I mean, interest payment alone right now, it's about 10%. But if you keep racking up this debt, it's just going to eat up the margins. And what I imagine will happen is if the board doesn't wake up and actually get incentives aligned for long-term, health of the company, what I imagine will happen is that they will just finance the debt. And when the debt comes, they'll take out more debt. It's just going to be this vicious cycle of more levering. Until until the board wakes up and actually starts to draft up a compensation plan that aligns with the long-term shareholder interest.
Well, and let's not forget also that this is a company now that can't be defensive about their position either, right? If they found an interesting business that they wanted to acquire, right, like a Shake Shack or something like that, to kind of diversify their lines, they're not really in a good place to do that long term, right? This is exactly why Toys R Us and companies like that eventually fail, is that their focus shifts to paying down. And in Toys R Us's case, it wasn't even Toys R Us, right? It was a private equity firm that bought them, levered it up to the hilt, and then eventually the business prospects soured enough that it wasn't enough to pay down their debt, right? McDonald's isn't there yet, and they may not get there, but you're just not going to see a good rate of return, right? They're not converting your cash into money, right? They're converting cash into interest payments, right? And debt payments. It's a waste of everyone's time, right? And the funny thing is the board will get paid, they get paid $250K a year to show up 4 times a year, have a sandwich, or a McGriddle, I guess. It's probably a McGriddle.
Yeah, exactly.
And then they leave, right? And that's
Chicken McNugget.
Yeah, and that's it. So it's kind of mind-boggling when you think about it, right? That's how this, everybody asked for independent directors, right? And and that was the thing in the 80s and 90s, that you wanted boards made up of independent directors. Well, now you have them, and those independent directors have literally no skin in the game. And so they're like, yeah, let's juice up returns now. I'm going to be on the board for like 3 years, so why do I care? I'm going to come here, show up, get my sandwich, my McGriddle, and then I'm done, right? So, I think that is fundamentally the problem with any board, right? Is you need to pay attention to these kind of things, and I think it's a good lesson in I mean, if I look at this and I compare it to a company like Ubiquity Networks, where the CEO owns 70% of it, and he essentially has all of his net worth tied up in this one venture. Well, he's going to put all his eggs in this basket, and he's going to watch it very closely, right? Nobody's watching out for my shareholder interest in McDonald's right now, right?
No.
So,
And by the way, that is the function of directors. That is the primary function of board of directors, is that you elect them. And by the way, you can elect them. There's proxy
yeah.
voting and everything else that happens, but you elect them to look out for your interests as a shareholder, and they're not doing a good job in many companies, because, like Hardy said, you get paid $300,000 a year just to come to a meeting every quarter and get a McGriddle.
That is one expensive McGriddle, I have to say.
Yeah. Exactly. Well, great. I thought this was an interesting, fruitful discussion.
Yeah.
I hope you guys enjoyed it. And like we talked about earlier, if you guys have a company that you'd like us for us to look into, please email us at info@valueinvestor.org. And also the Slack channel. Hari mentioned the Slack channel earlier in the episode. Please email us at info@valueinvestor.org if you'd like access to our community. Awesome. Thank you guys again for joining us. We'll talk to you guys in the next episode.
Thank you.